Everyone is talking about the Bitcoin ETF like it's the final approval crypto has been waiting for. But what if this whole ETF hype is actually designed to make retail investors the exit liquidity? Even some of the biggest Wall Street insiders admit, ETFs benefit institutions way more than individuals. And in this video, I'll break down how ETFs really work, who profits, and why the narrative might be hiding a trap for retail investors. And I'll be honest with you, I almost got carried away by this hype myself. For a moment, I caught myself thinking, this is it, Bitcoin is finally going to the moon. But then I realized, that's exactly the kind of mindset institutions want retail investors to have. Stay with me, because once you see how this trap is built, you'll never look at the ETF narrative the same way again. Let's get one thing straight, Bitcoin ETFs were never designed for retail. They were built for institutions. And while everyone's hyped about how bullish this is, the truth is, the benefits flow almost entirely to Wall Street, not to you. Back in the early days, if you wanted Bitcoin, you bought Bitcoin. Period. No middleman, no management fees, no Wall Street product standing in between you and the asset. But today, with ETFs, retail investors believe they've won. They see headlines about billions flowing into these funds and think, finally, this is the push that will send Bitcoin to the moon. Here's the problem, if ETFs really made retail rich, wouldn't we already see it in the price? Billions flowing in, but Bitcoin consolidating instead of exploding higher, that disconnect should make you stop and think. Why isn't the hype showing up on the chart? We'll get to that in a second. In reality, the only ones celebrating are the institutions, because ETFs give them exactly what they've been waiting for, a safe, regulated, scalable way to profit. They collect the fees, they control the custody, and they shape the flows. Retail investors? They're just along for the ride, usually in the worst seat on the bus. But that's only the beginning, because once you understand how institutions actually profit from this setup, the whole ETF story starts to look very different. So why do ETFs favor the institutions so heavily? It comes down to three simple things: fees, custody, and control. First, the fees. Every time money flows into an ETF, Wall Street skims its cut. 0.5% might not sound like much, but across billions of dollars, it's a machine that prints steady profits. Institutions collect, retail pays. Simple as that. Second, custody. Almost all US spot Bitcoin ETFs rely on the same few custodians, with Coinbase being the largest. Think about what that means. Instead of hundreds of thousands of investors holding their own coins, massive amounts of Bitcoin are locked up in just a handful of vaults. And here's something almost nobody's asking. What happens if one of those custodians loses access, or regulators freeze those assets? It's unlikely, but not impossible, and the ripple effects would be massive. I'll come back to this later, because the answer could shock you. Third, control. ETFs give institutions the power to move huge amounts of Bitcoin in and out of the market, but only during US market hours. They arbitrage price differences, they hedge, they play games at a scale no retail investor could ever touch. Meanwhile, Bitcoin itself never stops trading. Nights, weekends, holidays, it never sleeps. Guess who takes advantage of that gap? Not you. And that's exactly the edge institutions keep for themselves. So here's the takeaway: retail gets the hype, institutions get the system. But don't tune out yet, because understanding their game is exactly how you flip it in your favor. So here's the key question: if ETFs clearly benefit the big players, what can retail investors do differently? The answer is simple but powerful: it's the difference between exposure and ownership. When you buy an ETF, you only get exposure to Bitcoin's price. That's it. You don't hold the asset, you can't move it, you can't use it. It's like the difference between owning a gold bar in your hand versus a gold ETF on paper. Both follow the same price, but only one can you actually touch, store, or use outside the financial system. Owning real Bitcoin is completely different. Same price, different power. With actual BTC and self-custody, you can send it instantly across the world, use it on the Lightning Network, or even build on top of it with new layers and protocols. You don't just get the upside, you get the freedom that comes with holding the real thing. People say ETFs bring legitimacy. And that's true, but legitimacy for who? Regulators, banks, billion-dollar funds. Not you. For retail, nothing changes, except now you're up against players with better tools, deeper pockets, and more control. So the strategy is this: use ETF hype as a signal of adoption, but position yourself smarter. Keep stacking sats directly, dollar cost average, and most importantly, hold your own keys. Because if you don't, You're playing their game, and you'll lose every time. And remember that question from earlier about custodians losing access? Let's circle back to it, because that's where things get really interesting for retail investors who actually hold real Bitcoin. If a custodian fails or regulators freeze ETF assets, ETF investors can do absolutely nothing. They just sit there and wait while Wall Street and regulators decide what happens. No control, no say, no freedom. But here's the twist: for retail investors holding real Bitcoin, that kind of event could actually turn bullish. Why? Because it would create a supply shock. Coins locked up, tied in legal battles, or even lost from circulation. Less liquid supply with the same demand? That's textbook bullish for those who hold the real thing. Quick reminder, this is not financial advice, just my perspective as an investor. Always do your own research before making any decisions. This is why ETFs are such a double-edged sword. On the surface, they look like progress. But underneath, they concentrate risk, reward institutions, and leave retail with almost no edge, unless you're smart enough to step outside their game. Now, let's talk numbers, because if this ETF hype continues, here's the Bitcoin range I'm watching next. Here's how I'm thinking about it right now. Bitcoin is trading in the ballpark of $110,000 after a leverage flush. ETFs keep seeing on and off inflows, but the price isn't just exploding higher. That disconnect proves the point: ETFs are built for institutions, not for you. 3 things you can do today. Own real BTC. Set up self-custody. Even a small amount is enough to feel the difference. Automate your DCA. Stick to fixed times. Your plan, don't chase ETF hype. Set alerts around US market hours. Track flows versus price. If inflows rise while price stalls, that's your red flag. People say ETFs bring legitimacy. True, but for whom? Regulators, banks, billion-dollar funds. Not you. For retail, nothing changes, except you're competing against bigger players with sharper tools. That's why your keys equals your rules. Do you think ETFs are bullish for Bitcoin long-term, or just a trap for retail? Let me know where you stand in the comments. I read every one. And if this gave you a fresh perspective, hit like, so more people don't get misled by the ETF hype.